Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, US government shutdown threatens permanent layoffs, risking a Fed data blackout and derailing the soft landing. We'll examine how this political gridlock could blindside the Federal Reserve, impacting future interest rate decisions and market stability. Second, a 30% surge in Chinese stocks lures foreign capital, but the rally is built on government intervention and a fragile retail base. In this episode, we'll break down this policy-driven rally and what its potential policy cliff signals for global investors. Third, Congress pushes to rebrand Social Security ages as a nudge for retirees amid a fierce debate over raising the retirement age. Today, we'll take a closer look at this behavioural nudge and its implications for retirement security and the US labour supply. A memo from the Office of Management and Budget is now warning federal agencies to prepare for mass firings in the event of a government shutdown. The real turning point is that this isn't the usual talk of temporary unpaid leave or furloughs. The memo is directing agencies to prepare for a reduction in force, or RIF, which means permanent job elimination. This sets a new precedent for politicising the civil service and creates long-term uncertainty about how the government is run. With the deadline just 4 days away, this isn't a standard political spat. During the last full shutdown, 850,000 federal employees were furloughed without pay. That's a massive portion of the more than 2 million civilian federal workers in the United States. While those employees are guaranteed back pay, federal contractors historically are not. This time, the stakes are being raised even further. And the damage isn't just about the lost paychecks of government workers. It exposes a much deeper problem, a psychological shock that can spread through the entire economy. Economists call this a drop in consumer confidence, a leading indicator of future economic activity. So when people see political chaos and hear about mass layoffs, even those with secure jobs get nervous and cut back on spending. A sharp drop in confidence right before the critical holiday shopping season could weaken retail and services, creating a negative feedback loop for the broader economy. What really brought this to a head for the markets, though, was the next development. A shutdown could blindside Wall Street by putting key economic data on ice. The government is on track to shut down just days before the Bureau of Labour Statistics is set to release its monthly jobs report. The crucial consumer price index reading could also be delayed. This isn't speculation. After the 2013 shutdown, the jobs and CPI reports were delayed by about 2 weeks. During the 2018 partial shutdown, the first look at GDP growth was delayed by a full month, leaving investors and analysts in the dark. Now, for the markets, here's where it gets interesting. The Federal Reserve is like a pilot flying the massive airplane of the US economy. Economic reports on jobs and inflation, like the CPI, are its key instruments, the altimeter and the speedometer. They tell the Fed whether to raise, lower, or hold interest rates. Without this data, the Fed is essentially flying blind. This data blackout forces them into a cautious holding pattern, unable to make informed decisions. For markets, this uncertainty is toxic, potentially leading to major volatility in stocks and bonds as everyone tries to guess what the Fed will do next. The source of the gridlock is a fundamental disagreement. Congress must pass 12 separate appropriations bills to finance the government. To date, it has passed 0. Republicans are pushing for a clean temporary funding extension. Democrats, however, are demanding the bill include protections for healthcare subsidies under the Affordable Care Act. With a 60-vote threshold needed in the Senate, neither party can pass a bill alone, and negotiations have stalled. After all, this isn't just abstract political fighting. It has a real measurable cost. Research from S&P Global estimates that each week of a shutdown could shave 0.2 percentage points, or about $6.5 billion from real GDP growth. That could be the very thing that pushes a slowing economy into a quarterly contraction, shattering the soft landing narrative that policymakers have been hoping for. This political standoff is now directly threatening to halt national park operations, suspend veteran services, and delay immigration hearings. The conflict in Washington is on a collision course with the paychecks of hundreds of thousands of Americans and the essential economic data the market needs to function. However, if you zoom out, you'll see the global implications of this. This kind of self-inflicted wound damages the perception of US economic stability and governance. At a time of heightened geopolitical competition, it undermines global confidence and can even accelerate discussions about de-dollarization. For countries like China, which is a major holder of US Treasury debt, this political dysfunction in Washington weakens the appeal of US assets and increases long-term borrowing costs for America. It's a critical focal point for anyone watching global economic trends. Now, as Washington's dysfunction raises questions about US economic stability, a completely different story is unfolding in China. A stock market once deemed uninvestable is now so hot, one retail investor says she made an entire month's salary in just a few days. She's not alone. After years in the wilderness, Chinese equities are roaring back to life, luring in a flood of capital from around the world. But that's not the whole picture. This isn't just about chasing hot stocks. There's a massive structural shift happening in the Chinese economy. For years, the main investment for Chinese households was real estate. But with the property market in a prolonged slump and bank deposit rates falling, that money has to go somewhere. We're seeing a historic rotation of household savings out of property and into financial assets like stocks. This could be a multi-year tailwind for the market, but it also means transferring huge risks from the real estate sector directly into the stock market. To put that in perspective, Hong Kong's Hang Seng Index is up 30% this year, on track for its biggest annual jump since 2017. The Shanghai Composite recently touched a decade high. This isn't a random surge. It's a rally so directly tied to government action that investors have nicknamed it the 9.24 performance, dating its start to a rare coordinated press briefing by China's top financial chiefs. This government-led push involves what investors call the national team, state-backed funds and institutions being directed to buy stocks. Now, this decision brings both a huge opportunity and comes with inherent risks. While it can create a powerful short-term rally, it's a double-edged sword. The rally is built on policy, not necessarily on a strong recovery in company profits. In fact, while China's overall GDP growth looks good, it's being driven by exports and industrial production, while domestic consumer spending remains weak. If corporate earnings don't catch up to these high stock prices, the government might pull back its support, creating what analysts call a policy cliff, and a sharp market correction could follow. The signal was so clear that even skeptical foreign capital is taking notice. For the first time in 4 years, Cathy Wood's ARK Investment Management has started buying shares of Alibaba again. So the thing is, this flood of foreign money might not be what it seems. Many experts believe this is a short-term tactical play, not a long-term strategic shift. Essentially, foreign funds like ARK see Chinese stocks as undervalued and are jumping in to ride the wave of the policy-driven rally. The uninvestable argument, it hasn't disappeared. These capital flows, often coming through the Stock Connect program between Hong Kong and the mainland, are very sensitive to risk. Any new flare-up in US-China tensions could cause these funds to pull out just as quickly as they came in, which would put pressure on both the stock market and the yuan's exchange rate. Believe it or not, the entire rally is built on a foundation that's dramatically different from the West. One analyst bluntly states that many still see the market as a gamble, a casino, not a long-term investment. Let's focus on a single statistic that might just change your entire perspective on this market. In China, retail investors drive 90% of daily trading. For comparison, that number is about 20% in the United States. This creates a level of volatility that is almost unimaginable in other major economies. And that fragility is staggering because such a high concentration of retail investors makes the market incredibly fragile. Now, to be precise, recent data from China's securities regulator shows this figure has actually dropped below 70% for the first time, suggesting a slow but steady increase in professional institutional investors. However, it's still a market dominated by individual traders. And research from the Shanghai Stock Exchange has shown a stark reality. Over a recent multi-year period, while institutional investors made gains, retail investors consistently lost money. This reinforces that casino mentality where the odds are often stacked against the small player. That same investor who made a month's salary in days perfectly captures the sentiment on the ground, saying, as soon as I hear or sense the market going down, I'll grab my money and run for my life. This isn't just a market rebound. It's a high-stakes economic experiment fueled by government policy, but balanced on the knife edge of a retail frenzy where fortunes are made in days and could vanish just as fast. So what should we watch for next? The key will be to see if this policy-fueled rally can transition into a fundamentally sound one. Keep a close eye on upcoming corporate earnings reports. Are companies actually making more money, or are their stock prices just inflated? Also, watch for any shifts in government policy signals and data on the property market. If real estate stabilises, some of that household money might flow back out of stocks. The interplay between these factors will determine whether this is a sustainable new chapter for China's market or just another boom-bust cycle. That conversation about long-term household savings isn't just happening in China. Back in the US, a different kind of financial reckoning is underway, and it has to do with one of the biggest decisions of people's lives. Get this, a new survey reveals only 21% of adults know when they qualify for full Social Security benefits. That means nearly 4 out of 5 Americans are in the dark about one of the biggest financial decisions of their lives. This widespread confusion has triggered a rare moment of unity in Congress. The House just advanced the Claiming Age Clarity Act with a near unanimous 41-1 vote. The goal is to scrap confusing terms and replace them with language that hits hard. Under the proposal, early eligibility age becomes minimum benefit age, a stark reminder that claiming at 62 means a permanent cut. Full retirement age gets a new name, standard benefit age. And for those who wait, claiming at age 70 will be called the maximum benefit age, highlighting the potential for an 8% benefit increase for every year you delay past your standard age, up to a 24% total boost. This isn't just about semantics, it's a powerful application of behavioral economics. The nuance here is that the original language created what experts call a framing effect. The term full retirement age made it sound like the default, while early eligibility sounded like a special opportunity. In reality, claiming early is a trade-off, not a bonus. These new terms are designed to be a nudge. By calling it the minimum benefit age, the government is trying to make people pause and think about the financial haircut they're taking. The hope is that this clearer language will encourage more people to delay claiming, which boosts their monthly income for life. This could improve long-term financial security for millions of retirees, though it might also slightly dampen consumer spending in the near term from the 62 to 67-year-old group. But this is about more than just changing words. It's about real money and a much bigger fight brewing over Social Security's future. The program is facing a massive funding shortfall, and the debate over raising the retirement age is heating up. The situation presents a fascinating duality. On one side, there's a push for clarity, while on the other, there's a huge underlying challenge that often gets lost in the headlines. The controversy over raising the retirement age stems from the widening gap in life expectancy between high-income and low-income Americans. Research from the American Academy of Actuaries shows that raising the retirement age disproportionately punishes lower-income workers. Why? Because they often have shorter life expectancies and are more likely to work in physically demanding jobs that they simply can't continue doing into their late 60s. For them, a higher retirement age isn't just a delayed check, it's a benefit they may not live long enough to fully receive. This is the binding constraint that forces policymakers to consider other, equally tough options like tax increases. One Democratic representative put the stakes in sharp relief, stating, "For every year you raise the age, that is a 7% cut in benefits." The controversy even briefly ensnared the Social Security Commissioner, who first said everything's being considered regarding a higher retirement age, only to walk it back a day later. While lawmakers debate language, the core issue is the financial security of millions. The proposed wording changes are designed to influence claiming behaviour, which directly impacts retirement income for the rest of a person's life. Interestingly enough, the uncertainty itself is already changing behaviour. The constant political debate over Social Security's future seems to be a signal that younger workers are getting the message. They may not be able to count on benefits as they exist today. As a result, many are increasing their private savings rate. This has a ripple effect on the economy, boosting demand for long-term investment assets while potentially acting as a headwind against current consumer spending. So what happens next? If these nudges work and more people delay retirement, it could structurally increase the labour supply of workers aged 65 and over. This would be a major shift. This decision brings both potential benefits, like easing wage inflation in certain sectors, and comes with inherent risks, like altering career progression for younger generations as senior level jobs remain occupied for longer. We've seen similar dynamics play out in Japan. So a key indicator to watch will be the labour force participation rate for those over 65. This isn't just a clarification, it's a high-stakes effort to reshape how Americans approach their financial future. This content is for informational purposes only and not investment advice. Market data is volatile and subject to change.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.